Subscribe to my channel Report Stock.
So, what is the secret sauce behind the Magic Kingdom's recent finances? I mean, how are they actually pulling it off, financially speaking, in this crazy changing world?
Right. It's the big question.
Okay, let's unpack this then. Today, we're doing a deep dive into the Walt Disney Company's fiscal third quarter 2025 earnings report.
Yep. Got the numbers right here. Financials, segments, subs, future projections, the whole lot.
Our mission really is to cut through all those numbers, pull out the key takeaways, maybe some surprising bits, and just give you a shortcut to understanding what's really driving Disney right now.
Get you properly informed without needing to read pages and pages.
Exactly. Get ready for some aha moments, hopefully, as we look at how they're, shifting things around.
From old media to what's next.
Okay, let's kick things off with the overall picture, Q3 financial headlines.
Right.
And the standout success, I think, has to be the adjusted earnings per share. Came in at $1.61.
Yeah, that was strong. It beat the Zacks consensus estimate pretty handily.
By what, over 10%? And that's a big jump, nearly 16% up from last year. Well, that's pretty impressive, isn't it?
It truly is. And what's fascinating, is that while revenues did climb a bit, about 2.1% year over year to $23.6 billion, they actually just missed the consensus mark. Only by a tiny bit,
Right.
0.1%, but still.
So, wait, the earnings jumped way past estimates, but revenue just missed. How does that work?
Well, that's where the strategy comes in. It points towards efficiency.
Efficiency. Okay, tell me more. How are they doing that?
Well, look at their costs and expenses. They only went up 1% year over year. Just 1%.
That's pretty disciplined for a company this size.
Exactly. So holding costs down like that meant their overall segmental operating income jumped 8.3% compared to last year. Hit $4.57 billion.
Right. So it's not just about earning more, it's about spending smarter, getting more from what they already have.
Precisely. Getting more bang for their buck, essentially. It shows how a huge company like Disney tries to find growth and efficiency even when the market's, complex.
Okay, makes sense. So let's pivot then. Let's talk about the media and entertainment distribution segment. The content engine, basically.
Yeah, a huge chunk of their business makes up, 45.3% of revenues?
Yeah.
$10.7 billion.
And that was up slightly, 1.2% year over year. But you said earlier it's kind of a mixed bag when you dig in.
Oh, absolutely. Because despite that slight revenue uptick, the operating income for the whole segment actually dropped by almost 15%.
Wow. Okay, down to $1.02 billion. Why the decline there?
Well, a big part of that story is the linear networks, traditional TV.
The fading star, as some might say. How bad was it?
Pretty significant drop. Linear revenues are down almost 15% to $2.27 billion. And the operating income from them fell even harder, down nearly 28% to $697 million.
Ouch. Any specific reasons?
Yeah, domestically, operating income fell about 14%, mostly due to lower ad revenue. And that wasn't just lower rates, it was also lower average viewership. People are just watching less traditional TV.
Which we all kind of know is happening, but seeing the numbers really drives it home. It definitely highlights that shift to streaming.
Exactly. And that brings us to the other side of the coin in this segment. Direct-to-consumer, or DTC, the streaming services.
Right. This is where it gets really interesting, isn't it? The big turnaround story.
It really is quite something. DTC operating income, it flipped completely. From a $19 million loss last year.
A loss. Yeah, I remember that.
To a $346 million profit this quarter.
Wow. Okay, how did they pull that off? That's huge.
Several things came together. Strong subscription revenue growth, for one. They've had higher effective rates. Those price increases on Disney Plus and Hulu are kicking in.
People are paying more.
They are. Plus, subscriber numbers continue to grow, and there was also a sort of technical positive impact from Star India's subscription revenues not being in there anymore because of that joint venture deal.
Gotcha. And the subscriber numbers themselves, did they grow much?
Yeah, Disney Plus hit 127.8 million paid subscribers globally by the end of June. That's up from 126 million back in March.
Okay, steady growth. And are they making more money per subscriber, that ARPU number?
They are, mostly. Domestic Disney Plus ARPU was up slightly to $8.09. International Disney Plus if you exclude Hotstar, rose 2% just in the quarter to $7.67. That's price increases and subscription mix changes.
And Hulu?
Hulu SVOD only also ticked up a tiny bit, 0.3% to $12.40. So yeah, they seem to be managing those price hikes without losing too many people, which suggests folks still see the value.
Absolutely. Okay, staying within this media segment, what about content sales and licensing? The movie side of things, usually.
Right. The theatrical performance often drives this. And it's volatile. Revenue was actually up almost 7% to $2.25 billion.
Okay, sounds good so far.
But the operating results swung dramatically from a $254 million income last year to a $21 million loss this year.
Whoa, big swing. Why the loss?
Mainly lower results from theatrical distribution, plus higher cost impairments, basically write-downs on stuff that didn't perform as well as hoped.
So comparing films.
Yeah, this quarter you had releases like Elio, Thunderbolts, Lilo and Stitch. Last year, in the same quarter, they had the massive hit Inside Out 2. So, tough comparison.
Okay, that makes sense. So this whole segment, it really shows that balancing act, doesn't it? Trying to manage the decline in traditional TV, investing heavily in streaming to get it profitable, which they did, and then dealing with the ups and downs of the movie business.
Like a complex puzzle, for sure. Juggling old cash cows with new growth engines.
All right, let's shift gears completely. Let's talk parks, experiences, and products. This always feels like the magic continues here. Still a powerhouse.
Absolutely. Continues to be incredibly strong. Makes up, almost 40% of revenue.
38.4%, yeah. What did the numbers look like this quarter?
Really solid. Revenue's up 8.3% year over year, hitting $9.08 billion.
Nice. And operating income?
Even better.
Yeah.
Up 13.2% compared to last year. $3.51 billion. Just really strong performance.
And I heard the domestic parks were particularly impressive.
Oh, definitely. Domestic parks and resorts revenue was up 10% to $6.4 billion, and the operating income from them soared 22.5% to $1.65 billion.
Wow, what's driving that? Just people flooding back.
It's a combination. Growth in the domestic parks and resorts for sure, but also significantly the Disney Cruise Line.
Ah, the cruises are doing well too.
Very well. It comes down to increased guest spending. People are spending more when they're there and higher volumes. So more passenger cruise days, more occupied room nights in the resorts. Demand is strong.
Interesting though, I saw the international parks. Revenue was up, but operating income dipped slightly.
That's right. A bit of a nuance there. International revenues climbed 5.6% to $1.69 billion, but operating income actually slipped 3% to $422 million.
Any reason given for that?
Not explicitly detailed in the highlights, but it could be due to specific investments, market conditions, or maybe just tougher comparisons year over year in certain locations.
Okay. And consumer products.
Yeah.
The merchandise side.
Steady Eddie, really. Revenues up slightly, about 2.9% to $992 million. Operating profit also up just a tiny bit, 0.9%, to $444 million. A solid contributor.
So it really highlights the contrast, doesn't it? You've got the booming stable parks business on one side.
The cash engine.
And then the more volatile, shifting media landscape on the other. Shows why having those different pillars is so crucial for Disney. The parks probably help fund a lot of that media transition.
Absolutely. Provide stability and cash flow for those bigger bets. Now, looking quickly at the financial foundation, the balance sheet and cash flow. Always important.
Right. Give us the snapshot. Cash on hand.
As of June 28, they had $5.36 billion in cash and equivalents, down a bit from the previous quarter.
And debt.
Total borrowing stood at $42.2 billion.
Yeah.
Also down slightly from $42.9 billion, so managing debt levels.
And the big one for investors often, free cash flow. How did they do there?
Very positive. Generated $1.88 billion in free cash flow during the quarter.
That sounds healthy.
It is. It signals good financial health, strong liquidity. Means they're generating plenty of cash from operations to cover investments and run the business. That's crucial for funding everything we've talked about. Streaming content, new cruise ships, park upgrades.
Right, fuels the engine. Okay, so finally, let's look ahead. What's Disney telling us about the future? Their guidance for Q4 and beyond.
Okay, projections time. For Q4 fiscal 25, they expect total Disney Plus and Hulu subs to jump by more than 10 million compared to Q3.
10 million? Wow, where's that coming from?
Interestingly, they're saying most of that growth will actually be from Hulu, thanks to an expanded deal with Charter.
Ah, leveraging partnerships.
Exactly. Disney Plus itself is projected for just a, quote, modest increase in Q4. So, leaning on Hulu and partners for near-term sub growth.
Okay. And for the full fiscal year 2025, the overall bottom line.
They're projecting adjusted earnings per share of $5.85 for the full year. That would be an 18% jump compared to fiscal 24, pretty healthy growth target.
Definitely. How does that break down by segment?
They give some specific guidance there, too. For the full year 25, entertainment segment DTC operating income expected to hit $1.3 billion.
So solidifying that streaming profitability.
Yes. And overall, double-digit percentage growth in operating income for the whole entertainment segment. Sports, think ESPN mostly, projected for 18% operating income growth.
Saw 'em now.
And Experiences in the parks and products projected for 8% operating income growth for the full year. Still growing, just maybe moderating slightly from those huge post-pandemic jumps.
Got it. Are there any specific big investments or costs we should know about that might affect things?
Yeah, a couple of call-outs. The Disney Cruise Line expansion means pre-opening expenses of about $185 million for the whole fiscal year, with around $50 million of that hitting in Q4 25. Getting those new ships ready costs money up front.
Makes sense. Anything else?
They also expect an equity loss of about $200 million from their India joint venture. That's mostly due to accounting stuff, purchase accounting amortization from when the venture was formed back in November 24, just working through the integration costs on the books.
Okay. So overall, the guidance kind of reflects them pushing ahead on all fronts, right? Streaming profit, sports, parks, while managing these expansion and integration costs.
That's exactly it. It shows they're executing on those key strategic priorities across the board, bidding big on the future, like you said earlier.
Yeah, it really paints a picture of where they see the growth coming from and the investments needed to get there. So let's try and wrap this up. After this deep dive, what are the key takeaways for you, the listener? I mean, we've unpacked how Disney really boosted earnings, not just through revenue, but seriously through cost management and that big strategic shift in media.
Right, even with only moderate revenue growth overall. And that incredible turnaround in streaming DTC becoming a profit engine now.
Yeah, huge contrast with the struggles of the traditional linear networks. And we can't forget the parks, experiences, and products. Just unwavering performance, still a massive powerhouse, providing that stable foundation.
It really does highlight how a giant company like Disney has to constantly balance, its history and successes with where the future is headed, making these big calculated pivots.
Which leads to maybe a final thought for you to chew on. As Disney keeps navigating this, complex world, focusing on streaming profits, part growth, what do you think is the next big challenge or disruption they'll face?
Or the next big opportunity they should really jump on. Something maybe beyond what we've even touched on today. Is it AI? Is it some new form of entertainment? Evolving consumer habits? Something else entirely?
Definitely something to think about. We hope this deep dive gave you some fresh perspective, plenty to consider.
Yeah, hopefully it was useful.
Until next time, keep exploring, keep questioning, and keep learning.
Subscribe to my channel Report Stock.